What's up everyone, I'm Steven and welcome to my channel. This video is all about cryptocurrency for beginners. This will be an introduction to cryptocurrencies. I'll talk about what cryptocurrency is, how to trade cryptocurrencies, and cryptocurrency trading strategies. What is crypto? We'll focus today on cryptocurrency as a digital payment system that doesn't rely on banks to verify transactions. It's a peer-to-peer system that can enable anyone, anywhere to send and receive payments. Instead of being physical money that is carried around and exchanged in the real world, cryptocurrency payments exist purely as digital entries to an online database that describes specific transactions. It is essentially currency for the internet. When you transfer cryptocurrency funds, the transactions are recorded in a public ledger. You store your cryptocurrency in a digital wallet. What is the blockchain? Cryptocurrencies work using a technology called blockchain. Blockchain is a decentralized technology spread across many computers that manages and records transactions. Part of the appeal of this technology is its security. A blockchain is essentially a digital ledger of transactions that is duplicated and distributed across the entire network of computer systems on the blockchain. Each block in the chain contains a number of transactions, and every time a new transaction occurs on the blockchain, a record of that transaction is added to every participant's ledger. The decentralized database managed by multiple participants is known as a distributed ledger technology. How to trade crypto. Number 1. Make an account on a crypto exchange. To choose the best exchange for your needs, it is important to fully understand the types of exchanges. There are two types of exchanges. Centralized exchange. The first and most common type of exchange is the centralized exchange. Popular exchanges that fall into this category are Coinbase, Binance, Kraken, and Gemini. These exchanges are private companies that offer platforms to trade cryptocurrency. These exchanges require registration and identification, also known as the Know Your Customer or Know Your Client rule. Centralized exchanges are not in line with the philosophy of Bitcoin. They run on their own private servers, which creates a vector of attack. If the servers of the company were to be compromised, the whole system could be shut down for some time. Worse, sensitive data about its users can be released. The nice thing about these larger and more popular centralized exchanges are they are by far the easiest on-ramp for new users, and they even provide some level of insurance should their systems fail. While this is true, when cryptocurrency is purchased on these exchanges, it is stored within their custodial wallets and not in your own wallet that you own the keys to. The insurance that's provided is only applicable if the exchange is at fault. Should your computer and your Coinbase account, for example, become compromised, your funds would be lost and you would likely not have the ability to claim insurance. This is why it's important to withdraw any large sums and practice safe storage. Decentralized exchange. These centralized exchanges work in the same way that Bitcoin does. A decentralized exchange has no central point of control. Instead, think of it as a server, except that each computer within the server is spread out across the world, and each computer that makes up one part of that server is controlled by an individual. If one of these computers turns off, it has no effect on the network as a whole because there are plenty of other computers that will continue running the network. This is drastically different from one company controlling a server in a single location. Attacking something that is spread out and decentralized in this manner is significantly more difficult, making any such attacks unrealistic and likely unsuccessful. Due to this decentralization, these types of exchanges cannot be subject to the rules of any regulatory body, as there is no specific person or group running the system. The individuals who participate come and go, so there's no one individual or group that a government or regulatory body can realistically pursue. This means that those trading on the platform do not have to declare their identification and are free to use the platform in any manner they choose, whether legal or not. Some of the best and most trusted crypto exchanges are Coinbase, Binance, and Kraken. I'll leave a referral link to those exchanges below. Number 2. Pick a crypto to invest in. Always do your own research. Things to look at when researching: the community, fundamental analysis, the team, the technology, the white paper, their vision, their leadership, pricing history, credibility and reputation, and their roadmap. Number 3. Choose a strategy. Whether you want to invest 1% of your portfolio in Bitcoin, or if you want to be more aggressive up to 5 or 10%, here are the crypto trading strategies. Buy and hold, or HODL. Buy and hold is a passive investment strategy where traders buy an asset intending to hold it for a long time, regardless of market fluctuations. This strategy is typically used in long-term investment portfolios, where the idea is to simply get in the market without any regard for timing. The idea behind this strategy is that on the long enough time frame, the timing or entry price won't matter much. You would research and identify the projects you have high conviction in and you invest. Dollar cost averaging. Dollar cost averaging is a popular and well-tested trading strategy that works best when done over longer periods of time. The concept is simple. Instead of investing all your money in a particular cryptocurrency at once, you divide it into small accounts. Choose a particular time and day of the week and only buy at those times. Day trading. Day trading might be the most well-known active trading strategy. It's a common misconception to think that all active traders are by definition day traders, but that isn't true. Day trading involves entering and exiting positions on the same day. As such, day traders aim to capitalize on intraday price movements, price moves that happen within one trading day. Swing trading. Swing trading is a type of longer-term trading strategies that involves holding positions for longer than a day, but typically not longer than a few weeks or a month. In some ways, swing trading sits in the middle between day trading and trend trading. Swing traders generally try to take advantage of the waves of volatility that take several days or weeks to play out. Swing traders may use a combination of technical and fundamental factors to formulate their trade ideas. Naturally, fundamental changes may take longer to play out, and this is where fundamental analysis comes into play. Even so, chart patterns and technical indicators can also play a major part in a swing trading strategy. Trend trading, sometimes also referred to as position trading. Trend trading is a strategy that involves holding positions for a longer period of time, typically at least a few months. As the name would suggest, trend traders try to take advantage of directional trends. Trend traders may enter a long position in an uptrend and a short position in a downtrend. Trend traders will typically use fundamental analysis, but this may not always be the case. Even so, fundamental analysis considers events that may take a long time to play out, and these are the moves that trend traders try to take advantage of. Scalping. Scalping is one of the quickest trading strategies out there. Scalpers don't try to take advantage of big moves or drawn out trends. It's a strategy that focuses on exploiting small moves over and over again. For example, profiting off of bid-ask spreads, gaps in liquidity, or other inefficiencies in the market. Scalpers don't aim to hold the positions for a long time. It's quite common to see scalp traders opening and closing positions in a matter of seconds. This is why scalp trading is often related to high-frequency trading. YOLO. This one's pretty self-explanatory. Number 4. Store your cryptocurrency. The main purpose of the creation of Bitcoin as a decentralized currency was to give the masses the power to control and manage their own money. This will be taken to the next level with the introduction and adoption of more decentralized financing. First off, digital wallets are quite different as compared to your physical wallet. Instead of storing money, digital wallets store private and public keys. Private keys are like your PIN number to access your bank account, while public keys are similar to your bank account number. When you send Bitcoin, you're sending value in the form of a transaction, transferring the ownership of your coin to the recipient. Ownership of your private keys gives you total control over the funds associated with your corresponding public keys. That's why it is vital to make sure you keep your private keys secretly hidden so that only you know your private keys. If any other person gets hold of your private keys, they'll have control over your coins. It's also equally important to have a backup of your private keys as to protect yourself from an accidental loss. Hope you guys found this video helpful. If you did, go ahead and hit that like button and hit that subscribe button. Hit the notification bell for more videos delivered to you. Feel free to leave any comments or questions below, and you guys have a great one.